Hello everyone, this is Juan Sarmiento and today is Thursday, August the 20th. Here's my account, paper trading account, and just quickly to check an update, we have $88,000 in the account now, and that to me means that I could enter any trade that is $8,800 or less. So far this year I have made 30,000, which is about 50% of this account since January. Okay, so today I'm going to discuss the decision-making spreadsheet. This is an Excel spreadsheet that I use to enter my trades, and here are the details. I enter the trade and I calculate the price. Let me show you first Adobe, since this particular trade cost $144 per trade times 100. Okay, so that would be too big. Here I will enter the price, 144.38 times 100, because it's 100 shares, and the resulting cost will be $14,000, and that is simply too much for my account. I told you already how much is the minimum I need, so this is definitely out. I looked for other possibilities, but this was my best rate, so I enter here the details and multiply times 100. It could be 200, it could be 300, depending on the cost per trade. And so Adobe is too large right now for this account. If your account is larger, then you may consider it. Okay, so that's step number one. Step number two is the expected versus actual earnings. Okay, so for that, we could use the charts here and say enter Adobe. And here the previous earnings was $2.45, while the expected was $1.90. So here, $1.90 versus $2.45. And that is a 28% difference. If this number is 10%, you see the difference between those two, and divide that by the expected, and that here, that gives you how much was the beating. If it beats by 10% or more, that's great. Sometimes the good news are not in the earnings, but in some other piece of information that will tell you that the company has raised guidance, or that for some reason it expects a new revenue source. And that's not the case for Adobe here. This is just a good earnings play. Then here we enter the implied volatility. And let me just copy this trade, copy it, and take it to the platform here. I click here and say orders, and I click on this button here, and here's my proposed trade. So let's analyze that. And here we have the January is the back month, and September is the front month. Unfortunately, it would have been nice if they have December or November options, but they don't, and therefore it ends up being very costly. So in my Excel spreadsheet, I enter here the front month, just so happens that it's the lower here, calls and puts. That's the implied volatility, so 36.81, 36.33, and that's 36.52 is the average of the two. And the back month, 38.31, 37.39. And the difference is less than 3%, minus 1.82%. And that is acceptable. The skew usually turns out to be negative. If it is positive, great, don't even consider it. If it's minus 3%, that's my cutoff point. So here it says, okay, you can trade this. It tells me here that the difference, the earnings is great, so it says trade. I already set in the spreadsheet when to say trade or do not trade based on what the percent is. I might override this based on other pieces of information. Then the liquidity. The liquidity comes from the price of the trade. So let me just go back to the platform and say create duplicate, and that gives me the mid versus the natural. So 144 versus 153. 144, 153. And that says do not trade. Unfortunately, when we do this after hours, this might not be accurate. In any case, it is very wide between mid and natural. But if you could do somewhere in between, and probably during working hours, this mid versus natural will narrow. And if they narrow enough to make it less than 3%, then you could trade that. And then there is the current IV percentile. For that, we go to the trade tab and say all products, and that brings me to Adobe again, and I scroll down until I see current IV percentile, and it says 30%. Okay, 30%. I put it here. If you have two trades here, it says trade, good, trade here, it says do not trade and do not trade. Well, that's borderline, okay? You don't have to have them all trade, but it would be nice to have three. You know, in this case, I think that we have the liquidity might be different, might be actually less than 30%. So we could wait until opening of the market to see if that changes. But in our case, what is the significant portion is this, the cost of the trade. We cannot trade it because it's too costly for us. Also, you need to see what the implied volatility might be too high, and that's what this current IV percentile tells us. So it's 30% is a little too high. The volatility could still come down and hurt us. So I would simply say I'm going to avoid that. I have 1, 2, 3 more trades suggested. The other ones were from previous days. So let's look at Monster here. And in the case of Monster, you can see that the difference between the front month and the back month is just too large. 30% versus 25%, that's 5%. Minus 5%. The maximum acceptable is minus 3% negative. So that's a little too much. So I say no on this one either. The difference between expected and actual earnings is really good. So I'm tempted to enter that trade because of that. But when you see that the liquidity is also very large and the IV percentile is large, well, I only have one item here that favors me. So I said, well, I'm going to skip it. When I look at the trade, I don't have to actually enter all the data in my spreadsheet, but this is just I made so to illustrate to you that I look at these things and I weigh them and conclude whether I want to trade or not. Another one that I consider was TJT, and this particular trade has issues as well. Okay, $38.58 will be one trade, so that's good. Times 200, I could enter 2 of the trades. So that means I will be selling 2 contracts, 2 calls and 2 puts, and buy 4 contracts, 4 calls and 4 puts. And so essentially 2 short straddles and 4 long straddles. And the strike price for this stock would be 150. Okay, I'm entering it just to demonstrate. And here 38.58 will be $7,716. So this will be okay because it's less than $88,000. Okay, then obviously if you have a smaller account, you would adjust so that this number is 10% or less in your account as a maximum. Okay, so this didn't work either. And finally, I come to Nike, which is the one that I have selected for today. Let's copy that, the trade, and paste it here. Click on that icon and just click on this icon. And that brings me to my Nike trade here. I open the cost and then say Analyze Trade. And we're going to enter the same data. Okay, let's go back. So what was the earnings? Here, the previous earning was minus 51, while the estimate was 0.06. So you have to look, how come the stock is still going up despite the loss? And they probably recommended this stock regardless. Sometimes the earnings is not that accurate, but now we have moved far from the earnings, so that's not a big factor. I'm just interested in it because it just broke to a new all-time high. So the earnings is not favorable, but it's not a big deal either. And just recently broke to an all-time high. So I want to trade that for that reason. Okay, so disregard this is simply do not trade, but you have to see what the other source of revenues they are so that the stock is still going up or whether they set their guidance higher. Okay, let's look at the trade again, and here we have the implied volatility of the front and the back month. And that's front month is 30.73 versus 27.43. And the back month is 31.39 versus 31.16. And the difference, as you can see, is in the absolute less than 3%. That is more than minus 3%. In other words, okay, so that skew is acceptable. Now we look at the liquidity. Is it liquid enough? And let's go back there and say create duplicate order, and you see 26.65 versus 28.35. 26.65 versus 28.35. And that's 6%. I do not trade either. I'm surprised about that. I think probably during working hours it was less. The spread was less. Sometimes, yeah, I'm gonna have to see this if it can be traded. Obviously, it's not gonna be tradable. Let's look at the IV percentile. On the trade tab, go to the bottom of the trade tab and you see it says 15%. And that's right on. So that's acceptable. What is not acceptable is the liquidity, but that might be different after hours. Okay, let's look at the news. Sometimes you can get some information with the news that the stock to explain why the stock is reaching new highs. Okay, so they have target increase earnings guidance. That, I mean, raise target by an analyst. That's not a good reason to enter a trade. Goldman Sachs usually results in movement when they raise price targets. But generally speaking, we could stay away, or we should stay away from analyst raising ratings, because that usually results in a one-day move at the most. What we want with my Gini trade is a big move in either direction. Okay? You can go back and see what was the earnings back in June 25, but that's a little far back, I think. Much has happened since. Okay, so if you find something that you think is interesting, or if you are convinced that the stock will break out, which it did, that it will keep on going higher, which it probably will, then that's a good stock to trade. So I'm going to enter that trade. That's my decision based on what I have seen. But you know, that is very personal as to how you want to trade this. You can also trade the lower strike price, and that will be 105. That may be a little easier to trade, and it may fit my conditions better. Let's do them all and see if we get a difference. Let's do them both. Yeah, that looks a little better in the IV. Okay, let's compare them. Why don't we? You can copy that and paste it and see. Now we're going to do the 105. Perhaps that's a better trade. Okay, so back month, 32.34, 29.1, 32.12, 32.08. Okay, yeah, that's a better trade as far as the volatility is concerned. How about the liquidity? Is it more liquid? It looks tighter. Let's see. The mid is 26.39 and the natural is 28.02. $26.39. Sorry about that. Okay, that's not that much different. The fact that it's better here, why not? We could do the difference in pricing is not that significant, but it's good. It's better. And so my price have changed. My original trade under consideration was $26. Sorry, that was my other account. Okay, yeah, 26.65, 26.39. Yeah, so I'm going to enter this one here, 26.39. Sorry to keep jumping. Let's copy that and paste it here. And 26.39 goes here. 26.39, and that's close to $8,000, and that's acceptable for my account. If your account is smaller, then you can enter one lot instead of two. Okay, so let's do that. Confirm and send. Oh, I need to increase, let's say, multiple. Okay, I have only one lot, so I want to put two lots. 2639 times 3, so it's 3 lots really. So yeah, that's 3 and 6. Okay, my mistake. So let's put 6 and 3 short. Great. So then I say create duplicate, confirm and send, and it's now going to cost me almost $8,000. Let's send that off. Great. Okay. Now let me see what else do I have in my account that needs to be modified. After all, I'm not going to touch this until next Thursday. I might look tomorrow to see that my trade filled and that I might increase or reduce the price before the market opens or after the market opens, so that to make sure that the trade gets filled at a good price. Let's look at Apple here. Apple has been reaching and getting to a new high, and they are going to split. Remember, I told you, I believe I told you that with the split setup, what is going to happen is where all of our options will be quadrupled. Okay, while the price will be on each option will be divided by 4. Okay, and here what I have is old put here that's a lottery ticket. I don't think it's worth anything anymore. 28 cents. I'm gonna leave it there. It doesn't bother me at all. It's 28 cents, $2.80. But the trade now, you can see the risk graph here. We have a 23 delta. We could modify this trade. I want to take profits. How do I take profits? Well, I reduce my deltas by rolling over one of the long calls. I call that long call the outstanding call. You have 2 longs and 1 short. That makes only 1 outstanding. That's the difference between the long and the short. Sometimes you have 3 lots, 4 lots. So in the case of Nike, we have 6 longs and 3 short. That means that I have 3 outstanding calls, and you might sell 1 outstanding call. You would hear me refer to, I'm going to sell 1 outstanding call, or in this case, I'm going to roll up my outstanding call. And that means I'm going to sell the 410 call 1, okay, and I'm going to buy 1 at a higher strike price. That way I neutralize my delta. You see here my delta is 23.52. By doing that, I reduce it to 80 cents delta negative. Okay, so it's slightly negative, but if Apple continues to go up, I'm going to keep on making money, but I'm collecting quite a bit of money by doing that. That's 38 times 100, $3,817 I collect by doing this roll up. That means I am lowering the amount of money that I have in this trade. Okay, so let's do that. If you want, you can enter a new trade for Apple at that strike price. I might do that, but I'm going to wait until after the stock split. Perhaps. I don't know what I'm going to do. But for now, this is what I'm going to do, okay? I'm going to roll it up just in case the stock collapses tomorrow for whatever reason. Let's continue on. We have Costco, and in this case, we have 11 is my next expiration. That's fine the way the spot it is. I'm not going to touch that. We have Facebook, and here we have a lottery ticket at 205, short call, and we have a long call. Okay, obviously I rolled it up as I went along, and I'm not going to change that. I'm just going to let it. What is going to happen is that this long call may be assigned, and if it is assigned, I can just exercise this one option long at or I can just close. If it gets exercised, I end up with 100 shares, just like I did in my previous video, in my last video. I showed you how to do this once you get assigned, how you get out of an assignment by essentially buying a covered call, which would buy the 100 shares back and sell your long put. That's a covered call. I can just wait until that happens. Doesn't bother me. But if by whatever reason Facebook fell to 205 tomorrow, I'll be laughing because suddenly I made a lot of money on that. Let's move on to MNST. Okay, in this case, we have leftover trade, and you can see that I have the long 80 call that's very much in the money now, and I'm just going to close that. And the put, as you can see, is worthless, so I'm going to leave that. I'm not going to get any money out of that, but I'm going to get $4 times 2, that's $8 times 100, $800 by closing this. Okay, NST might be a trade we want to do. So we might enter a new trade. I think I calculated that and it turned out not to be a good idea. Okay, do not trade, do not trade, do not trade. So that didn't work out. Let's move on. Microsoft, I have also a lottery ticket. I will consider another trade. Not just yet. Nike is the one that I just entered. Oracle. I'm not going to touch it. We have September of 11th expiration, so there's plenty of that. Of time. It's not expiring, so I don't need to do anything with it. Same with this PYPL, that's PayPal. It is for September expiration, so no change there. And this is UPS, no change there either. The expiration is September. I just entered that. So this is what I do every Thursday. I check my trades, see what needs to be rolled up or rolled over or closed. And I'm happy the way they are right now. So that's all for today. Thank you very much for joining me, and I'll see you next time. Bye-bye.
Please be sure to subscribe to this channel by clicking on the subscribe button below. Once you have done that, be sure to also click on the bell so you get a notification of future videos coming up in this channel. Be sure also to click like if you enjoyed this video, and feel free to share it with your friends and family. Thank you very much.